To me, especially living in beautiful New Jersey, where my property taxes are high and my income taxes are high, that was a pretty big impact. Between state taxes and property taxes, mine personally was probably north of $40,000 together.
Back in 2017, we got limited to $10,000, right? Before that, it was technically unlimited, but there's some caveats with AMT and whatnot. But now, what's happening is it's been raised, the SALT caps, so state and local, state income, property taxes, etc. It's been raised to $40,000. So we now have a much higher threshold. The only caveat is, once you hit $500,000 of adjusted gross income, you start getting carved out. And basically the way it works for I would just say for every $10,000 you go up, you get reduced and basically get to around $100,000 and you get back down to $10,000 at the end of the day, right? So you go up to 40, once you go all the way to 600,000, oddly enough, lines up with the excess business loss cap. And so now you are stuck with $10,000 of SALT cap again.
Is that AGI or is that taxable income?
It's adjusted gross income. And it's also only for 5 years. It's one of those provisions that did not get permanent. We'll have to see what happens when we get to 2028 and how everything shakes out then.
All right, what's going on, everybody? Today we got a special episode. We're going to try to keep it light, quick, but entertaining at the same time because we just had the big, beautiful tax bill come out not that long ago, right for the July 4th weekend. And I wanted to jump on this as soon as possible to break it down a little bit with an awesome guest, a person who's been closely following all the developments and stuff. So Nate, tell us a little bit about yourself, where you at, and how did you get involved in the deep dives of BBB?
Yeah, thanks for having me on today, Yuri. It's like, yeah, we'll try to have fun talking about tax law. I know that's like what makes everybody super excited. But it makes me super excited. But yeah, so my name's Nate Sosa. I'm the manager of our national tax department at Hall CPA. Been with the firm for about 2 years now. Been a blast. Been a really fun time working at a firm where we're doing everything else that people who listen to Yuri's podcast, trying to change the industry, do things differently, trying to be different, right? That's what's awesome, and being game changers in this space is fantastic, right? And so I kind of just got into this. So I first started my career starting reg right when Tax Cuts and Jobs Act happened, right? So this is where I got an opportunity. So basically it was like, oh wow, the partner who's worked in this industry who was around when 1986 tax cuts got put into play, right? Way back then.
Yeah.
Now I get the same opportunity to understand this law like they do. So that's what I was like, that's really interesting. I'm going to try and understand it. And I got to understand QBI. I actually got like a sim question on QBI when I was taking my exam. I was like, okay, just take a second, breathe. I'll figure out these like crazy deductions. And it's like, oh wait, it's just 20%, right? It's super easy.
Yeah.
But yeah, I just got into it because it's fun. Politics is interesting to me. Just seeing like the give and take. And then also it's like, hey, guess what? It also impacts what we do. And more so recently, we've seen with the COVID legislation, with the Democratic legislation, and now the new Republican legislation, tax is a new club that they figured out that they can beat the other party with, right? And so it's just going to continue being optimized either to incite the voter base or to punish the opposite, right? So it's very interesting just to see how all this plays out and how they pull tweaks and levers to mess with our giant Jenga tower that's about to fall.
Yeah, it's good. It's a great summary. Yeah, man, politics is interesting. Politics around tax and all that certainly is interesting. And I do feel like a lot of times the folks doing it don't understand, a lot of times the dynamics and what it is. It's just sometimes just words that people use, to try to get people excited. Like, and the public is obviously equally, if well, obviously much more confused because they hear tidbits, they hear sound bites. But today we're going to focus on us tax pros, right, out there. Those of us who have not been following the journey of the BBB as it was making its way through, and if you haven't heard anything about it, let's dive right into just some of the stuff that has changed from the TCJA, from the way that we were used to doing things in 2017. So why don't we just dive right into that, some of the high-level stuff, some of the more popular stuff that's going to affect a bunch of people.
Right, yeah. So to start, I'll say is that like originally back in 2017, we all wondered what was going to happen in 2025, right? Because there's a bunch of sunsets that were going to happen. It was like, man, I wonder what's the world's going to look like in 2025. Will we have flying cars? Who's going to be in power? I don't think the current party expected to be back around to put this
Yeah.
back in place, but here we are. And so, what happened ultimately is, there are definitely new provisions, but a lot of the current provisions just got made permanent. So we don't have to
Yeah.
worry about anything falling off in the future. We don't have to worry about sunsets for a lot of these provisions. Some of them do, but most of them, QBI, standard deduction, the current tax rates, the gift and estate tax exemption, right? All of those are permanent. Anything, pretty much most of the permanent deductions that were in existence beforehand, those are permanent now. They're here to
Nice.
stay. They're not going away until another Congress comes through and says, "Oh yeah, we're gonna yank that." So that's always possible. But
Yeah.
for now, most of the stuff for probably a long period of time is going to remain a part of the tax code.
Yeah. Yeah, that's true. So let's dive into those things. First things up, to me, especially living in beautiful New Jersey, where my property taxes are high and my, income taxes are high as a percentage. Let's talk about that. To us here, the folks in the Northeast area, that was a pretty big impact.
Absolutely.
Between state taxes and property taxes, mine personally was probably north of 40,000 together. So talk about that going. So we went from 10,000 to where are we at now?
Yeah, so back in 2017, we got limited to $10,000, right? Before that, it was technically unlimited, but there's some caveats with AMT and whatnot. But now, what's happening is it's been raised, the SALT caps, so state and local, state income, property taxes, etc. It's been raised to 40,000. So we now have a much higher threshold. The only caveat is once you hit $500,000 of adjusted gross income, you start getting carved out. And basically, the way it works for I would just say for every $10,000 you go up, you get
Yeah.
reduced, and you basically get to around $100,000, and you get back down to $10,000 at the end of the day, right? So you go up to 40. Once you go all the way to 600,000, oddly enough, lines up with the excess business loss cap, and so now you are stuck with $10,000 of SALT cap again.
So basically, it's like 30%, right? So on every dollar after 500,000.
Basically.
So and until you're back at the 10,000. So you essentially that range there you're losing. So if you're at 600,000, you're and what was that again? That was
10K
is that
cap.
AGI? Is that AGI or is that taxable income?
It is adjusted gross income. So it's an adjusted
Okay.
gross income. Yeah, it's adjusted gross income, and it's also only for 5 years. So it's inflation index, which is good, but it's
Yeah.
only for 5 years. So we'll have to see what happens when we get to 2028. It's one of those
Yeah.
provisions that did not get permanent. And we'll have to see what happens when we get to 2028 and how everything shakes out then.
Yeah. So while we're on this topic too, I was reading, and this was a little bit confusing from what I was reading. The like PTET, all those kind of elections to get around that we used to have, like, are those limited to 40,000 too, or is that still in play?
It's a great
Like, how does
question.
that work?
So there's a lot of back and forth on this, and we probably don't have time to do it today. But
Yeah.
basically, PTET, no limitations. Nothing's been touched on PTET, no limitations. They're all in effect. It seemed politically averse to kind of like have higher taxes on businesses from the GOP.
Yeah.
So they
Yeah.
decided to not touch that provision and no changes to PTET, right? So you have personal, state income, and local tax deductions, and then you have the PTET deductions, right? So if you haven't elected into PTET, you probably will be taking those deductions on your Schedule A. But if you elected into PTET, you're still going to be deducting it at your business 1065 S Corp level.
Yeah. Yeah. Interesting. So that'll be that'll be the income tax piece of it. So that still hasn't changed. And when you say PTET, does that also do you think? I'm assuming that applies to like the Bates out there, like the New Jersey version of PTET. And all those other California, all these other states that have the same concept.
California, the New Jersey, right, North Carolina. There's all these
New York.
PTET regimes that exist, right? I thought they'd be gone.
Okay.
Turns out they're here to stay.
All right, cool. Yeah, we won't dive too much into it. I know there's also the charitable stuff that's in there in this way, but we won't dive too much into that. But that's good to know. So, 40,000, great. Gonna be. I think it's gonna. I personally think there's gonna be a huge tax savings just in that piece alone.
Mm-hmm.
Now, can we talk about? Obviously, we can jump right into QBI because I think that's super relevant. So that was one of the permanent things that is at the moment staying forever. Has there been any change as far as the SSTB or any of those kind of functionalities, or maybe the
Great,
W-2
yeah.
limitation?
So originally there were versions of the bill that had a lot of adjustments and basically like had an opportunity for SSTBs to take advantage. Like, hey, the accountants are like, finally, it's about time, right?
Yeah,
But
yeah.
that got yanked out. So now it's just like basically we're just playing by normal QBI rules. They tweaked two things, right? All they tweaked was they increased the 20% threshold, right? It's been inflation adjustment for index, so I'm probably not saying the exact number, but like $100,000. If you're under $100,000 and you're married filing joint, you get the pure 20% deduction, right? That got bumped up to 150. So if you're a sole prop or something like that, and you're just getting started, guess what? You're actually going to get 20% because you'll never kick into that SSTB time frame, so you'll get to use the full benefit. That is something that's interesting there. The other item was basically this like bottom floor of if you make at least $1,000 in your business, and if you make at least $1,000 and you participate in this business, think of it as a side hustle or something like that, you get a $400 QBI deduction basically. So it's whatever's greater. So they're basically trying to raise the floor a little bit for side hustle type businesses. It's a small tweak, but could be relevant to a lot of people.
Yeah. Now, can we go to the SSTB from recalling the old rules? It was like there was that cap or the threshold below which I think it was like 315, below 315 or something like that, where even if you were SSTB, you married, this is married jointly, you were fine. And you didn't have to do any of those calculations. Then there was that like 100,000 little like piece of it where you had to have a little bit of a carve out, and then anything over 415 was you got nothing. So is that still in play, or has that been adjusted?
No changes to that whatsoever. Yeah. So all those old strategies and all those old things, those are just permanent now. And so we'll just that did not get adjusted or changed at all.
Okay, got it. Cool. So yeah, same kind of stuff around that, and I'm assuming that the 50% limitation on 2.5, so 50% limitation on wages, 2.5 on the unadjusted basis and assets, that stay the same too.
Yeah, it's one of those things where we had a lot of news coming out from like in the House bill of what was going to change with QBI, and then it got to the Senate and it just kind of got diluted, obviously, and then basically just 20%, no real changes, move on forward type of thing.
Got it. Now, I know one of those weird little changes with that 23%, and everybody was getting excited that it was going to be 23%. They got yanked out and brought back to 20.
Just be careful with that. If you're reading a post and you see 23% QBI, that is probably an AI generated post. Just FYI.
Yeah, that's a good point. Obviously, the most exciting thing, bonus depreciation, right? We can jump into that. You do a ton of real estate stuff. The folks over at Hall are phenomenal at it. Brandon was on my podcast years ago too, himself. So I know you guys do a ton of stuff in the real estate space. Real estate is excited about this. What are your thoughts on it? What are your thoughts on it in general?
Yeah, I think 100% bonus. So interestingly enough, and I'll probably hit on these other two provisions, is that we're getting closer and closer to a point in tax where maybe you're just going to purchase something and write it off, right? So you're just going to be income based, right? If you put money into your business, you're going to get deductions. You might not be taxed. And in the years you don't, you'll be taxed on that income, right? Because 100% bonus depreciation being permanent, no cliffs, anything like that, that basically means that there's much more ability to tax plan and game the system, right? You can put a property in service now. You're not forced to rush to try and get it done in 2022. If it lands in 2023, no problem. Obviously, you can't take a deduction in 2022, but that's okay because you're going to take now one caveat and one piece that's going to hurt some people, I think, this year is there's a weird time frame between the placed in service date. It's it's placed in service, right? Which feels really easy, but it's also acquired. And there's a little contract carve out too. So let's say that you purchase a property, you sign the contract on the 24th, but you don't have the whole title and deed change happen until end of January, right? A month afterwards. Unfortunately, since you purchased property before January 19th of 2025, you're stuck at 40% bonus depreciation.
Wow.
So that's good. So that's something that definitely need to pay attention to. Also, constructed assets. So if you're constructing if you're in the middle of construction of a building or are in the middle of construction of a building, you start in 24. There are ways that you can carve up the property almost with elections to kind of have a lot of it be 2025 bonus eligible, but portion of it will not be, right? So that's there's a lot of really important factors, like when certificate of occupancy, when all that happens. We'll get regulations on this, but we got actually something where this happened in 2017. So I would say it's really easy to go back and look at those rules, see what they
Yeah.
said for the most part, and say, hey, if you've written contracts, you were constructing before then, you're not going to be eligible for the 100% bonus, and you'll be trapped at 40 or 60% depending on which year all of it started.
So it's going off the contract date at the moment, like
Yeah, it's
so
going off the contract date when you had like a binding
versus
contract.
placed in service. So if you sign the agreement to buy it, but it only came to you, like you said, in January or February,
Right.
you signed it. Unfortunately, that's what you're locked into.
Yep.
Okay, so that's good to know. That's certainly good to know. There are a lot of questions around that, especially in January, and everybody's trying to do that. So obviously, with all that, all of the short-term rental, loophole in quotation marks, is going to be blasted on social media heavy.
Yep.
And I mean, at least now some of the folks that I've seen post about it, especially as bonus was going down, the 40%. I mean, it was just silly to see, because obviously you can't 179 those things you carve out. But I also think that we're going to have so much more G-Wagon nonsense again.
Yeah,
It
a
was
lot more,
annoying.
a lot more G-Wagons. And you brought up 179, the other part of the bill that got a boost too, right?
Yeah.
So 179 also got a boost, went from $1.5 million of deductions to
Yeah.
$2.5 million, right? So it went up a
Wow.
whole million to basically like what can be written off now. And this is the other caveat what makes 179 trickier than bonus depreciation. Just a CPE on that is
Yeah.
the big key difference is bonus. You elect into bonus, you elect out of bonus depreciation. So that's one of the key things to think about. And so we got an increase. So now we can write off $2.5 million of 179 equipment, and the placed in the acquired 179 eligible property, right? Which is what can happen a lot of times. I had a client purchase a gas station for like $5 million, right?
Yeah.
Gas stations can be expensed super quick. We looked at 179; they're over the threshold, so they couldn't use any 179 deductions. Now it's raised to $4 million. That client can't use it, but another one could because it's a much higher threshold, right? So there's a lot more ability to do these immediate expensings and immediate write-offs.
Yeah. Nice. But I mean, I'm assuming they haven't touched on. I'm certain that you cannot go below zero. With
Correct.
the 179,
Yeah,
you cannot generate a loss.
Taxable income limitation still in play. That didn't get modified. It's just like you have like higher thresholds of deductions, which can be helpful because 179 states conform with 179 a lot more times than they conform with 100% bonus depreciation.
Fair. That is true. Yes, because it can be a lot more of those adjustments and those differences in the states and stuff, which was always a pain in the butt when I was at the big firms, especially. What about, I mean, just tax rates in general? Big shifts, small shifts, or about the same?
So tax rates in general just got locked in, right? So which is great. So our current rate system of 10%, 12%, 22, 24, 32, 35, 37%. 37% are new, going to be probably for a long time established highest income taxable bracket. There was discussion of a going back to 39.6 bracket, which would be like I saw like the text was like $25 million of income, so super high up there. That's not going into play as of now. Now, what happens with Congress, sometimes things get floated. They might not appear for a while, but they might come back down the road. You never know, but it can happen.
Yeah. Interesting. So generally they stayed about the same and they did not change.
No, they stayed the exact same. So our 10, 12%, no adjustments there. That just was one of the things that got made permanent, right? So that, standard deduction, child tax credit, right? Those items got made permanent for what they have been to what they're going to be in the future.
Yeah, and from a bunch of the stuff that I was reading through, I mean, it seemed like it maybe went a couple dollars up and down, like the child tax credit, those kinds of things. It was
Right?
not
Yeah.
tremendously
Like
major.
$30 per kid. Yeah.
Yeah, the one thing that I saw was pretty exciting, interesting conceptually, because I know Trump was talking about this stuff, and it was talking about the what's it called, no tax on tips and overtime. Fascinating, but in like functionality, like how's that going to work out? Like, is the W-2 not going to have a tips line anymore?
So it is going to have a tips line, right? So now it's
Okay.
going to basically it's going to be even more reporting around tips is what's going to happen. There's going to be even more reporting around tips. So like anyone that's in the payroll space, guess what? You're going to have some late forms coming your way, probably mid-January. They got to then shove out to your software providers. Then got to shove it around. I'm just thinking about I used to do some payroll back at my firm, and how crazy that process would be, and all that would go into it. I know some CPA firms still do that, so there's going to be a lot of new boxes that need to go into play for that. And so basically, that's how it's going to reference. I saw someone say this. I don't remember who it was. Is that it looks at adjusted gross income. So if you're a married filing joint, you've got $300,000. You make you are below that. You're going to qualify for the $25,000 tip deduction, which is pretty substantial. Honestly, the more people I think about it, the more people it applies to. The girl does my hair, who I haven't seen in a while, so that's why it's a little long. And then also my sister-in-law, she works in the beauty industry, and this got opened up to the beauty industry. So hair salons, aesthetics, right? Those people are going to really get to take advantage of this too.
I think the majority of the folks out there that are in those professions that are earning tips probably will be, impacted positively by that. I just wonder, like anything else, they roll it out, and then how do you how do you functionally track this?
So how do obviously a lot of cash tips go unreported, right? So it goes unreported, it doesn't happen. But the credit card tips, those are the ones that show up, right? Those are the ones that can't be basically all electronics, that can't avoid that reporting. So functionally, it'll just show up on the form, and so basically. It'll show up on the W-2, or if you're a business, right, you'll have you've got your own line that you'll claim on your Schedule C or partnership, that you'll have to make sure that you they has to be classified in that box, right? Before you toss it all in the gross income, but now it has to be identified there. It's gonna have to come if it comes out in K1 statement, etc. So many reporting changes are gonna need to be made with this. Treasury/IRS are supposed to in 90 days send out a bunch of professions that should qualify or they consider to be tip industries. We'll see if that happens in 90 days, but hopefully we get it by then.
It's going to be interesting, man. All of a sudden, all these contractors are going to be over there going, I got $25,000 in tips.
Right. I
already foresee that coming.
Yeah, and it has to be, so there's a lot of rules to it. It has to be an industry that previously has had it, right? It can't be SSTBs, unfortunately, unless they carve out some specific ones, right? So us accountants can't have a $10 invoice with a $10,000 tip,
what's
right?
Going on, man?
They don't like us. They don't like us at Capitol Hill. They're not big fans of us, unfortunately.
Yeah, no, they don't like us. They just like us to enforce the stuff, but don't benefit from it. So I know we touched on a few of the big things. Like I said, I didn't want this to run too fast, but let's go for like a 5-minute, if you're tax planning, right, you want to add that value. I know, and you and I are in this other chat and on the WhatsApp, and it's awesome. And I know there's a ton of folks in that one that are super high level, dealing with corps and big stuff. But for those of us like myself who deal primarily with businesses with under $5 million gross revenue, the way I look at it, there's not a tremendous amount of stuff that's changing for those folks, with the exception, obviously, of the SALT cap and some of the planning around the PTET kind of things. But what are some things, obviously QBI planning, but that was always a thing. What are some things that maybe we could just talk about for 5 minutes of things that we should be thinking about now with BBB versus TCJA?
Yeah, so one thing I'll say is excess business losses. They did get, it looks like they were going to be stuck as excess business losses, and they wouldn't get to have that favorable NOL push over to the next year. That didn't get changed. So that's just FYI. We don't have to worry about that piece of the planning. Before, I was like, man, that's going to be really hard to utilize now. But you don't have to worry about that piece. QBI planning still in effect, like you mentioned. I think there'll be some opportunities, like restaurant, talking to restaurants or even other types of businesses that previously didn't have tips or didn't have overtime or something like that, and maybe looking into restructuring that, right? Maybe some accounting firms will even start trying to restructure how their employees are paid if they're paid on a overtime rate, right? And so now they can get that differential tax-free up to $25,000. That's a substantial chunk of change in your pocket that you get 20%, 30% back on. So there's opportunities there to think about for sure. I definitely think, like you mentioned, the SALT cap is a major one that we can really help our clients with tax planning, because that $500,000 number, we really got to play around and see how can we get that number down, or how can we keep it below that threshold, right? That's going to be a really important piece to nail there. So that one's really important to me. Also going to be the new. they call it 237's limitation. It's essentially the new piece rule, which is really weird. I don't
Yeah.
understand why they did it that way, but like basically with charitable contributions, like you mentioned, is that like gaming those so that they can get the biggest bang for their buck, right? Doing this, a
Yeah.
lot of this requires a lot of hand holding and tax planning with these clients, but to work with them for the projections and figure out, okay, hey, are you planning on making a big gift at the end of the year? So how much? Right? All right. What are you expecting
Yeah.
your income to be? Because when you get to that 37th rule, it becomes the lesser of whatever the charitable deduction is, or becomes of whatever you're over 37% threshold, right? So there's a lot of gaming that can be done there, a lot of math that we have to wind up doing for clients. So which
Yeah.
is what we're here for, right? So it's a lot there. Bonus depreciation and 179 deductions are always massive in my opinion.
Oh, 100%.
And so QSBS, right? You can work with a $5 million business who's eligible for QSBS. Got a massive expansion there too on how clients can do that. It's only eligible for stock issued now, not previously. So everyone else has been issued previously, plays around the same rules, but now they get a lot more rules. They get to play around and just like helping them understand what happens when they sell. That they have 3-year exits, 4-year exits, and then a 5-year exit. So it's a lot of opportunity to plan around there too. And real estate, right? Obviously in real estate, lots of opportunity. All the cost seg folks are going to love this bill because there's a lot of opportunity now for people to take deductions that maybe didn't get to or were sitting on the sidelines with their money. So there's like a lot more opportunity, in my opinion, for people to save on taxes.
100%. Bonus and 100% what you said. But no, they have, the cost sec folks are going to be blowing up now, more so than before. Because again, as the bonus depreciation was going down, the benefits and the upside of doing the cost seg was kind of weighed down a bit, in that realm because you weren't getting as much of benefit, but you were like carving out, some of your longer lived assets. So this has been awesome. This has been interesting. I think we'll do another one. I'd love to do another one with you. And in maybe a couple months as maybe some of those floaters, some of those things out there that are uncertain will come back around. But before we kind of part ways, where can people find you? Who should find you? Because I'm honestly just glad that I did through that WhatsApp group and LinkedIn. But where can the people find you?
Yeah, so you can find me on LinkedIn and Twitter. Just follow Nate Sosa CPA. So just hit me up there. I've got a weekly newsletter. It's really been focused on the tax bill, obviously, for the past couple of weeks. But now I'll be doing a write-up tomorrow about my top 5 favorite provisions. And then I'll also be breaking down strategies we can implement as tax professionals and how we can utilize all this stuff. So hit me up there. Also, Hall CPA is going to be doing a lot more continuing education too. So if anyone is interested in that, please come find me there, and we'll be doing a lot more of that stuff as well. Especially next week. We have a webinar on this that's CPE eligible for anyone that's interested.
That's awesome. This is great. Well, thank you so much, Nate. I appreciate you coming through. We'll do this again for sure. Thanks for doing it on such a short notice. And this was fun for me. I don't know about you, but this
awesome,
is great.
Yuri. I'm glad we actually got to meet face to face.
Yes. And man, we'll do it again. Till then, peace. Have a good one.
You too.
We'll talk soon.